It's particularly a good week to talk to you because you used to be inside that room, and we'd love to have your thoughts about exactly what the Fed is doing, what it should do. And to set up the discussion, I'll put up a chart here that I'll just describe to you, which really indicates what the market's expecting now in terms of rate hikes in 2019, and it's come down substantially. The market basically is anticipating, if not a pause, at least a slowing down of rate hikes. What is the right policy for the Fed?
Well, I think my own view all along, David, pardon me, has been that the Fed needs to be a little more aware of the risks that are posed to a continued recovery. I mean, it does seem to me as though the difficulties that inflation has getting above 2%, given the kind of employment growth we've had, suggest that there are some secular forces holding it down. But I actually think, what I believe is of less importance than that the Fed articulate to everybody what their view of what's going on in the economy is. Rich Clarida is giving a speech this morning entitled Data Dependence and Monetary Policy. I think maybe he'll explain how they are going to filter the data on which they're dependent. It's one thing to say, look, we see industrial production is pretty good, employment is pretty good, but durables aren't so good and housing isn't so good. That doesn't really give you a narrative for what's going on in the economy.
So what would a sensible narrative be? And I'll put a chart up again to illustrate something you were talking about, which is they've had some difficulty really getting to 2%. We just had the San Francisco Fed come out and say basically we think we're really vulnerable on keeping it at 2%. So what are the data they should be looking at? I believe that Janet Yellen, with whom you served, really focused on the labor market and slack in the labor market.
That's correct. I mean, Janet was probably a little bit more inclined to models than Jay Powell has suggested that he is, but she was no slave to them. Her narrative, as you suggest, was looking for the indicators in the labor market other than the straightforward unemployment rate. And it was at the point where part-time unemployment and labor force participation changed that she thought that it was time to start moving rates. That articulation of the narrative helped, I think, people both inside the Fed and outside the Fed understand her reaction function, and thus helped understand where the Fed was going to take rates. And if people disagreed, they could say, look, she's not going to be able to pull this off because we don't think she's got it right. So I think that's what one wants to hear from the Fed, is how they're putting the data together. On the inflation front, David, that's been a chronic problem now for a decade. And again, there's this contest between the cyclical forces pushing up inflation and what I suspect are some fairly important secular forces that are holding it down.
So you agree with the San Francisco Fed, then, that the acyclical factors that have helped inflation are going to peter out?
When, Alex, we don't know. At some point they will. I mean, it does seem as though we're in the late stage of a recovery right now. On the other hand, unemployment is still quite low by historic standards. Wages are finally creeping up a little bit. So one could tell a story that there's more to go and that there will be more pressure on inflation over the course of the next year or so. It's not the direction in which I would be inclined. But again, the question is there a narrative that suggests that that may be the case?
Do you feel like we're starting to hear that narrative from the Fed, though? I mean, in the last couple of weeks, we've heard from Williams, Clarida, and Powell, with all of them seeming a little bit more reticent than maybe the minutes that we'll see on Thursday will suggest. Powell saying that they're thinking about how much further to hike and the pace. Clarida saying they're closer to neutral. Williams saying raising interest rates somewhat. I mean, is that what they're doing?
It appears to. Look, the Fed has been about as close to autopilot as it ever gets for the last year or so. And now, and I think your earlier guests this morning were giving some reasons why, now there's probably a bit of a rethink going on. They're trying to project a little bit more uncertainty about the pace of increases. I think, we're going to have to probably wait until the December FOMC meeting and the new dot plot to see whether the bulk of the FOMC is reflecting that same uncertainty.
Dan, you started out by saying the Fed should be perhaps a little bit more aware of some of the risks. Let's talk about what those risks are that they should be more aware of. Again, I'll put another chart up that basically shows that with the rate hikes, we now are starting to see financial conditions, both in the United States and more dramatically internationally, really tighten at this point. Is that something they should be concerned about? What are the data they should be looking at to be concerned about risks?
Well, I think a couple of things. One, the relationship between the Fed balance sheet runoff and monetary policy and straight federal funds rate monetary policy is something that people have been wondering about. And again, I think it's something that it would be useful to hear the Fed's view on, because the financial conditions tightening presumably have at least something to do with the runoff of the balance sheet. How those things come together and how the Fed explains them could determine how much importance they're attaching to some of the indicators that are reflected on the graph. In terms of what they should be looking, I mean, ultimately, again, I think the U.S. economy is what their focus is going to be. That's what they should be looking at. But where are they putting the weight? My own view, again, is that the sluggishness in inflation and the fact that we do seem to be hitting a bit of a plateau, and that we can anticipate that as the effective fiscal stimulus runs off next year and as the lagged effects of monetary policy start to click in a little bit more, the economy becomes more vulnerable to even a moderate external shock.
So, Dan, one other factor that you didn't have so much when you were on the Fed, and that is the President of the United States and Twitter. We have President Trump who's tweeting out, and even just yesterday he tweeted out, "It's so great that oil prices are falling. Thank you, President T," referring to himself. Add that, which is like a big tax cut, to our other good economic news: inflation down. Are you listening, Fed? This is not the only time he's tried to send a message not too subtly to the Fed. What should be the effect of that?
Well, I think, ironically, David, it'll probably have, at least at the margin, a little bit of the opposite effect that he would like. As I've just indicated, and as your and Alex's questions have indicated, there are some reasons to think about how quickly rates should be raised right now. But when the president intervenes, like he has, it's going to raise questions in the market as to whether a shift in Fed policy is because of what he's saying as opposed to their analysis of the market. And so I think, at least at the margin, it might incentivize some members of the FOMC to stay the course or to hike rates a little bit more quickly in order to maintain credibility with the market. So his not being so vocal might actually help the cause that he's trying to promote.
And finally, Dan, let's talk about your old bailiwick, the regulatory side. We have a new sheriff in town, so to speak, Randy Quarles, somebody whom you know. I know you respect him. What do you make of the shift in the regulatory approach under Mr. Quarles?
Well, up until relatively recently, most of the changes, both by Congress and by the banking agencies, were directed at the smaller and medium-sized banks. And although one could agree or disagree with particular changes or how far they went, I think most people were reasonably relaxed about those. What's changed recently is that now some of the proposed relaxation is going to affect the biggest banks. I mean, they reduced the cap. They're proposing reduction of the capital requirements for the super regional banks. And with Randy's latest speech on stress testing, there's a pretty strong suggestion that he, at least, would like to respond to the industry's requests to give them more data, to make the stress test more predictable, to remove the leverage ratio, all things that would have the effect of reducing the information value, I think, of the stress test. So we'll see how that goes. I think he was speaking for himself and not for the whole Fed, but the direction certainly indicates that the GSIBs, the most systemically important institutions, may get some relief.
Well, pursue that, because you are sort of the father of stress tests, and a lot of people have said that's one of the most effective bank regulatory tools. At the same time, I did just read his testimony from November, Mr. Quarles, and what he said is, this is a matter of transparency. We want to be more transparent. Transparency sounds pretty good. So what's wrong with saying, yes, we should sort of let the banks know what the rules are that they're playing by as they go into the stress tests?
Well, here's the thing. If you give the banks enough information so they know what the Fed's supervisory model is, then they can plan their balance sheet at the time they're going to be submitting their balance sheet to the Fed for the stress test, in order to take advantage of the particular loss functions that are in the model. If they're not fully sure of what those are, it gets harder for them to do that. Now, the reason that's important is it means that you're not getting an indication of the average loss function for a particular kind of asset class. Instead, you're getting the bank being able to, with precision, say, ah, yeah, we'll have this asset because it gets a lower risk weight. Now, you can do that if you want. But if you do that, it means that in order to get the same kind of resiliency in the banks, you'd have to have the post-stress minimum capital requirement higher. And I think some banks would accept that trade-off. I think other banks just want their capital requirements lower.